Hi, and good afternoon, FourThoughters. Welcome to, I guess, the second mid-year econ review. I was trying to think about this, Jake, how many of these we have done over the years. So I figure I was able to start doing our own economic review maybe 10 years ago, and we've done it 4 times a year. So
Well,
that would
and
be like
and
40 times.
yeah, and Scott, remember during COVID, we did these a lot more frequently too, right?
Yeah, we were doing it weekly. We were doing it
Yeah.
weekly. So, welcome. The purpose of our webinar today, which is something that we really are looking forward to, is we spend a lot of time each quarter looking back at our notes at the beginning of the year. We lay out our big picture strategy and thinking, and we really have a 3 year, 1 year, and then a quarter by quarter outlook on the economy. And this has been one of the most crazy periods of time from an economic standpoint because almost every week there's new data and new information coming at us, primarily from Washington, but also geopolitically. So you'll remember the street signs that we had at the beginning of the year, and we have this lovely poster to remind everybody of our street signs. What's been remarkable is a lot of the geopolitical activities, events that we were worried about, inflation, impact on tariffs, Middle East conflicts, a lot of those things haven't been resolved, but the market is anticipating positive resolution. So anyway, we got a lot to talk about, and I'm kind of jumping the gun on that. Jake, welcome. Our theme this semester, I guess, is called Journey to EPCOT. And the idea is that everybody goes to the Magic Kingdom and everybody goes down Main Street, USA. And that's wonderful. We live on Main Street, USA. We're going to continue down Main Street, USA. But we want to take an excursion, a day trip over to Epcot and talk about that. So with me is Jake MacFarlane. Jake is a CFA and analyst with us at FourThought. I'm Scott Pinkerton, managing member. Welcome. And so, Jake, why don't we dive into our disclosures?
Absolutely.
And then, Jake, you'll be the moderator. So I'll turn it over to you to start walking through our slides, explaining the slides, and then I'll do my best to commentate on the FourThought vision on each one.
Yeah, of course. And just a reminder, nothing we say here today is a recommendation to you. We'll speak in general terms about the economy. But if you are feeling a little bit nervous about the markets or just want to revisit your overall investments or risk, please give us a call. We'll get you set up with your financial planner to review those. And so today we've got a couple different items on the agenda. We're going to start with kind of that Main Street USA. This is something that everybody's familiar with. We'll go through not only the US market and how the different stocks and investments have done this year and in previous years, but we'll also go through the economy as well. We'll spend a good bit on the US economy and some of the data points that we're seeing. Then we'll kind of get into that world of discovery, getting into Epcot. We'll talk about kind of what's the innovation that we see out there with AI. And we'll also talk about global markets and alternative investments. And then don't forget the World Showcase. This is where we're going to look at kind of the global realities and some of the investment themes that have kind of been prevalent over the last few years. And we'll look at the US dollar as well. So Scott, just kind of looking at the S&P 500, right? The US stock market. I think this slide here is great. It really zooms out, going back to the late 90s, and you can see different periods of expansion and then contraction. And what really stands out to me is kind of in the more recent years, right? Really kind of since COVID, those spikes and dips are a little bit more pronounced, right? Than what we saw kind of on the left side of that chart. So kind of take us through where we're at right now and some of the things that sticks out to you on this chart, maybe starting with valuation and then working through some other items.
Yeah, the first thing that jumps out to me, Jake, and this is going back from 1997, it's the S&P 500, all the way through the end of this quarter. And the first thing that jumps out at us is pattern recognition. So one of the biases we have as investors and as people is that we see patterns when there really is just random information. So what this shows us is back in the 2000s, we had the market go up, hit a peak, it went down 50% and went back up about the same amount, it went down another 50%. And so one, people say, gee, it won't go 10 years without making any money. Well, it certainly has and did. We didn't actually break through the high of 2000 permanently, assuming that that's permanent, until about 2014. So we made a ton of money for clients over those years, but that's how long it took for the market to get back to its previous high. Valuations, Jake, if you can hover over that PE ratio, price to earnings ratio, that's the expense level of the market. If you have a hot dog stand and it made $1 last year and you sell the hot dog stand to your brother for $20, that's 20 times earnings. $10 is 10 times earnings. If you're a buyer, you'll want a lower PE multiple. And you can see that at the peak in 2000, it was a 25 multiple. In 2007, at the peak, it was a 15 multiple. In 2020, it was a 19 multiple, 21 multiple in 22, and now it's about a 22 multiple. What does that tell us? It tells us that the market, the stock market, ain't cheap. You know, based on earnings, we have to pay a lot of money for a share of stock. Valuations are high, but also treasury yields. You can look at that bottom line and you can see that at the previous peaks, you know, treasury yields were at 1.6% in 20 and 22. Now it's at 4%. So there is an alternative to the stock market, whereas prior there wasn't. And the dividend yields of the stock market are at 1.6. So in 2022 and the previous peaks, dividend yields were higher, treasury yields were lower, valuation is higher. So all in all, from a valuation, relative and specific, the stock market's expensive. That doesn't necessarily mean that it's going to go down. But if you look at returns over time, the returns over time you get when investing at all-time highs with market valuations peaking are just lower. So point number one on Main Street USA, you want to make sure to rebalance. You don't want to take an abnormal risks right now. If you need money over the next 2 to 3 years, get it out. It's just common sense investing.
Yeah, Scott, one thing to hover over there, and we'll get into the index concentration right now. But when you talk about, hey, the market's expensive, doesn't mean it's going to go down, right? I love to like deconstruct what a total return of an investment looks like. And you can get part of your return from dividend income, right? You can get some of your return from a stock by increase in earnings, right? Or profits. And then the last kind of part too is multiple expansion or contraction. And so I think, guys, we're talking about maybe projecting returns or forecasting what returns could be. We're not expecting, multiple expansion from this point, seeing that we're
Right.
already pretty high. So that
Right.
could be a challenge. But I think too, guys, we look at like the makeup of this index. One thing that's really interesting right now is when you think of a market index, you think of like a broad encapsulation of all the available stocks within some market. And typically the index is very diversified. And then maybe you'll look at active managers who maybe get a little bit more concentrated in a couple names. That's kind of gotten flipped on its head now with how large some of these companies have gotten. So a market cap weighted index like the S&P 500, this chart on the right hand side, it shows us with that gray line that the top 10 names in the S&P make up almost 40% of the total allocation of the S&P 500. And the rest of the 490 names only make up about 60%, right? So that right there would say to increase kind of the level of risk with that portfolio because you're getting less diversification in a sense.
Yeah.
Now, however, the green line shows us that the top 10 contribute a lot of the earnings to the S&P 500, and that has spiked up. So that's a good thing. But Scott, I think what's pretty interesting is if we look on the left-hand side, which shows us the valuations of the S&P 500, which we talked about being 22 times, but it also just cuts it between the top 10 and the remaining 490 stocks. So what are you seeing that's pretty interesting there, Scott?
Well, I read something the other day where NVIDIA, which is the chip manufacturer that's doing such a great job with AI, it's been in the news with Jensen Huang debating with or having the meeting with Trump, that its market capitalization, a single stock, is greater than the Russell 2000. So 2000 listed companies, the market capitalization is less than one company. It's the first $4 trillion company. That was fascinating. But then I realized that NVIDIA's earnings were substantially more that single company than those 2000 companies combined. So one thing that jumps out at you is there is a disparity between the rest of the market and the top 10 companies as far as the price level, but it's still expensive. So any way you slice it, our opinion is don't run scared, but it's not time. We call it chips in, when a gambler pushes all their chips in and says, let's go. Now's not the time to do that. Also, by the way, you'll notice on the bottom right of the webinar, you'll see a Q&A. Feel free to type in a question. We're live and we'll take that question and do our best to avoid it. But if we have to answer it, we will. So yeah, so that's concentration. Jake, back to you, buddy.
Yeah, so the top 10 are expensive, but also the remaining 490, they're not super cheap either, right? They're
Right.
trading at a premium to their average. But let's take a step back now, Scott, and instead of looking at US stocks, let's look at US monetary policy, which is in the headlines every day, right? We've got political pressure that the Federal Reserve Chairman Powell is kind of facing right now. I just thought it was interesting to kind of take a step back and let's remember what the dual mandate is for the Federal Reserve. He's got to balance each side of these scales here. And on one side, you have achieving maximum employment, right? So the health of the labor market. On the other side, you have maintaining a long-term inflation rate that's not out of control, right? So they set a 2% inflation rate over the long term. And so the question that I've fielded a lot is how come the Fed's not lowering rates now that inflation has dropped so much and the labor market's in a pretty good shape? And so what I provided here is a little table that takes a look at the economic projections that the Federal Reserve makes every quarter. And so what this shows us is for the end of 2025, their expectations. We have real GDP growth, unemployment rate, and inflation. And it looks at what they just came out with in June versus what they were thinking in December. And I think there's some pretty interesting disparity or kind of happenings here with GDP coming down, employment rate rising slightly, but then inflation kind of picking up here. So Scott, I was curious to get your thoughts there on what's transpired over this year that's causing the Fed to kind of pause.
I remember when I was a kid, I used to work at a local, it was called Tin Pan Alley, which was an all-you-can-eat buffet in the Venice Bypass. And if you had ever gone into that kitchen, you would have never eaten there. And when you look at the way the Fed and economists make up some of these statistics, you'd really wonder how much you want to, eat of those statistics. We got to measure something. We got to do our best. But well, that's a theme that we always have, which is when you really break down how these statistics are put together, you just got to pause and understand it. So the first thing is GDP. So GDP, right away, you say, boy, a lot of folks were predicting a recession. We still have positive GDP growth. That's good. So the threat of the recession and this idea that most economists thought we were going to have a recession. Doesn't appear like they're thinking that now. So that's good news. It seems like all of this turmoil in government policy, the big beautiful bill, the huge, the tax implications of that, and tariff, the markets have kind of settled down. when they announced the tariffs, a lot of American companies went out and pre-bought all of their supplies. So net imports spiked, and that's a deleterious impact on GDP. So I don't put a lot of credence into that weak GDP number, uh, because that was really distorted from that. But the inflation number, that's a number 3% versus 2.5%, and that's really before the impact of tariffs. So inflation is a little stronger. Unemployment is a surprise. On the one hand, we're all thinking about immigration and the deportations and all of that. But when you actually look at the statistics, the number of deportations is actually lower this year than it was under Biden. But certainly we don't have people coming across the border. So what is our labor supply like? Another thing that's happening that people forget are folks that are just a little bit older than me and my age, the baby boomers. That's a huge spike of folks that are retiring. And so the labor force is shrinking, and the participation of those over 55 are shrinking. So there's a lot of noise in these statistics. But remember this, and we'll talk more about the Federal Reserve, because that's what this whole thing is about, is Jerome Powell made a singular big mistake when he said one word 2 years ago. This inflation we think will be transitory.
Transitory.
Yeah. And of course it wasn't. And what the Fed did is they had high inflation and they cut rates. And of course, that exasperated the inflation. So now, according to the Fed policy, they've cut 3 times, in the last 12 months. They're pausing. They're seeing the impact of tariffs. And if things start to weaken, and we'll see this in just a second, they'll start lowering rates again.
No, that's so true. And let's stay on the inflation discussion here. And this chart's pretty interesting. It goes back really since 2015, but when it gets very interesting would be at the beginning of 2020. And the blue line is the CPI, or inflation, assuming that 2% trend, right? If that were to just maintain right where the target is at, 2%. The red line shows our actual CPI rate of change, which was about double the hope, right? Double the target. It increased about 4% annualized since January of 2020. And so that cumulative effect means that we're about 11.4% above that 2% trend. And so a couple things. Number one, yes, inflation is coming down, but that year over year change is still positive, and it is still above that 2% trend. So that cumulative effect has still gotten worse. And also we have to remember this effect on everyday wallets, right? And kind of like that grocery store effect. Things are still more expensive than they were to a degree back when the inflation rate really started to pick up. And so, Scott, what kind of stands out to you on this one?
Well, the idea of having a targeted inflation rate is to have the trend, follow the trend, and businesses can then make, business capital allocation decisions, and investors can make the similar decisions. And we're just way above trend. And, the logic would be to get back to trend, we're going to have a period of disinflation or lower than 2%. I don't think there's the political appetite to do that. But again, Japan has proven that sometimes you don't have any control over it. So it's something, it's interesting. And even if inflation comes down and we say, yippee, we're at 2% inflation, it's not going to feel like it, because we still have that built-in inflation spike that, I went to get a sandwich today in downtown Venice, tuna melt sandwich for $20. I feel like my grandfather saying, how expensive things are, but this is real. So that's going to have an impact on people. And we're really seeing it in the lower income sections of our economy. And we'll talk more about them. They're going to be particularly pained by tariffs, and we'll talk about why in just a few moments.
Yeah, and so when we break down inflation, right, and again, see how kind of the sausage is made, this is not a perfect calculation either, as we know, Scott. And
It's a mess.
yeah, and we had an uptick, right, in the CPI that just recently came out. It's up to 2.7%. So that was a negative surprise. And when we look at the components of the CPI. We still see shelter costs being high, and also we gotten some disinflationary pressure from like energy. So that has worked in our favor to bring inflation down a little bit. But there are other costs that aren't even being really considered in inflation. So Scott, what are some of the items that stand out to you?
Well, one of the small items you see there is that little red line. That's auto insurance, and it's up close to 100% in the last 5 years. That's crazy. The big component that jumps out at you is that dark blue component, and that's housing. So we have a combination of housing prices at their all-time high, and we would have expected those to start to come down, and they are, but not anywhere near like people expected. And of course, interest rates are high. So housing costs are high. Rent, in 2021, it increased 18%, and that spiked it. And those rents are coming down substantially. I think last time I looked, rents were actually shrinking, and they have been since 2023. But when you look at the housing statistics, we're at the epicenter here in Southwest Florida. You look at the 5 or 10 worst housing markets in America, and it's littered with our neighbors. Northport, which is technically where I live, we saw a 15% drop in condo prices year over year. Northport housing sales, though, so you're starting to see condo prices drop. Housing is still getting like 93% of the asking price. No one, you're not seeing the volume, but people are refusing to lower prices, and people can't afford it. So the number of houses, are sold is down like 28% year over year. So people aren't dropping their prices. It's kind of a frozen market. But long run, housing prices are gradually coming down, led by multifamily and condos. And so that's going to be have a lowering impact on inflation. So kind of baked in the cake is lower inflation from those housing costs.
Yeah, that's absolutely right. And even like healthcare costs, right? Like
Right.
not exactly shown here, but we know that that's up as well.
Yeah, and the statistics on healthcare is crazy because they're using the price of health insurance, and the actual statistic says it's going down. I don't know a single person whose health insurance has gone down in the last 3 years. I don't understand how they could get that statistic, but anyway.
Yeah. And so let's move on to kind of the other side of that scale, looking at the labor markets. And there's a couple charts here. The one on the left shows job openings, and at glance, right, looks like, man, that's a big decrease. But
Right.
remember, this spike happened post COVID, right, when the economy opened back up again. We had, and if you look back, this goes back through the 1970s, right? And that was an abnormally large number. We're kind of getting back to that pre-COVID norm. And looking at the quits rate, that is come back down to pre-COVID norms as well, but maybe even a little bit below it. Layoffs, we've seen somewhat muted activity, but starting to pick up slightly. It seems like the labor market, as we look at the unemployment rate around 4.2%, wage growth still positive at 4%, which is above the current inflation rate. Labor market seems to be in a pretty good spot. But Scott, interested to get your thoughts on it as well.
Tariff, tariff, tariff. We don't know what that, when suddenly you have such a disruption in the supply chains, you're going to lose jobs, in the importing businesses and the distribution businesses, and you're going to pick up jobs from manufacturing domestically. So that's in flux. And as much as people want to predict and tell you, we really don't know. The impact of Doge, don't underestimate that. One of the things that our government is really good at right now is signaling something big, and it has an impact across the board. And Doge is one of those things. I mean, people are just hesitant to quit their jobs because of some of this publicity that's taking place. And another impact that we just are starting to see hit us is the impact of AI. So all of my career, there's been a thing where the high paying, low skill jobs in America were going offshore, and we're going towards robotics. And so everyone went to the higher paying, skilled jobs, the white collar jobs. Well, AI is coming for that. So anyone from graphic design, writing, edit. I mean, there's just the repercussions of this is phenomenal. And I can feel it in our business. We're able to do a lot more with fewer workers. And it's just beginning. So we need to keep our eye on jobs. We have a diminishing supply of labor, and it's getting lower, especially with our immigration policy. We're not seeing childbirths. On the other hand, at the same time, we're increasing employment demands from manufacturers. So we'll see how all of this works out. Maybe all of those white collar jobs will go back and get training in trades because that's where we're going to need them.
No, that's great. And so let's bring this full circle back to the Fed and what are they going to do with interest rates? And I think this chart is very cool. We got a couple different colors here, so I'll kind of explain what those mean. We have the gray line, which is the current or the historical federal funds rate, and right now it's right around 4.25, let's say. The blue diamond, the dark blue, is going to be the Fed's year-end estimate. And so at the end of this year, they're expecting that rates come down to 3.9%. The green dot is going to be the market expectations. And so the market is saying and pricing in that they believe the Fed funds rate will be even about 1 to 2 rate cuts below where the Fed is expecting to be at, around 3.6%. And that continues on to the next year where the Fed is at 3.6 and the market is at 3% flat. And so right now there's a mispricing or a difference of about 50 basis points or 225 basis points cut between what the Fed is saying and what the market expects. So Scott, what's your initial reaction to this? There is a lot of times a deviation between what the Fed says and what the market expects. And so what's your kind of take on it?
Well, the Fed does this dot plot where they're looking longer term and strategic. And then you have the market, which is reacting to all of the daily news and the daily noise. So we did some research and we said, okay, does the Fed tend to follow its dot plot or does it tend to follow market expectations? And the answer is, as far as predicting what the Fed's going to do, it's market expectations. So what the market is telling us is that the Fed's not going to lower interest rates at its upcoming meeting, but then we'll have 2 cuts throughout the end of the year, probably 25 and 25. And so I think that's kind of the way to read it. And when you look at what that's going to do to the yield curve and other factors, expect that to come to fruition. Now, if there's shocks to the system, I think we can make some changes, and it'll be interesting to see the political muscling that's taking place and whether that'll have an impact. My guess is that it won't. And even if it does, it's the Federal Board of Governors. There's 12. And so Jerome Powell is just 1 vote of 12. So enough said.
Yeah, and the next chart will actually look at the yield curve, and just as a reminder, right? And to know that the Fed, they can control the interbank lending rate, right? And that's what banks will basically lend at overnight to get their funding in store. That has a high correlation to short-term interest rates, especially like the 3-month Treasury. However, looking out anything past that is going to be the market that influences that, and its supply and its demand. And the curves that you see here, there's 3 lines. I'll walk through it right now. The dark blue is what we have at the end of June of this year, the current yield curve. And that's a pretty steep, what we call a J curve, and that it starts out pretty high in the 3-month, dips lower, and then it ends up higher on the 20 and 30 year. What we compare it to is, number one, we saw the 10-year Treasury peak back in October of 23, so a little bit less than 2 years ago. And we saw the 10-year spike right around 5%. And other than that, it was an inverted curve slightly. Then the green is going back even a little bit further to July of 23, and that's the peak inversion where short-term yields just got raised higher above 5%, and the 20 and 30 year were right around 4% or even lower. We noted that that's not normal at all. It doesn't make sense to be able to earn more on your short-term investments than on the long-term bonds. And so, but right now, I think this curve is incredibly interesting, and it kind of agrees with the point that we made earlier of what the market is expecting the Fed to do. So, Scott, why don't you walk us through that?
If I was on a desert island and could get one statistic to give me a view of what's going on in the US economy, I would want this yield curve. When you see an inverted yield curve like we have in 2023, that's the market predicting future lower interest rates. And why would the market predict future lower interest rates? If they smell a recession, if they smell things slowing down, and the Federal Reserve will have to lower interest rates. When you see a normal inversion, then you can, it's kind of a green light towards an expansion. So what do we have now? We got this wacky J curve thing where the short-term 3-month is paying as much as the 10-year. So we're getting, I guess I would say, let's pause on this. And as the next 3 months, 4 months, 6 months come to fruition in the anticipation of those short-term rate cuts, perhaps we'll see this become more of a normal sloping yield curve with very little recession risk. So interestingly, that in 2023, it was definitely a signal that a recession was coming. Never happened. So I think that the current read of this is that there's something either really funky going on, and we'll understand it later on, or we're just going to have to let the next couple of months matriculate, and as the Fed lowers interest rates, we'll see that curve return to normal. That's kind of our base case. But it is
Yeah,
troubling.
definitely. And as you said, Scott, the yield curve so important that we'll give you two different looks at it. So this chart here, it takes a look at the current yield curve, which is in that orange, and then I'm sorry, which is in the purple, and then we look at the beginning of the year, which is in the orange, and we can see here that a lot of the shift from the beginning of the year to now happened in that intermediate belly of the curve where the 1 year all the way through the 10-year has come down, potentially signaling, hey, future rate cuts are supposedly down the pike. However, the short term's kind of being held up and pinned by the Fed and their pause, but also the long term, we see a little bit of maybe term premium seeping in, but also maybe fiscal concern even more because we'll get into what the deficit looks like, Scott, but we're on a pace to have to issue a lot more bonds in the future as well.
And that's true. It's also true a lot of the developed partners that we have, which is a somewhat positive, somewhat negative thing. But you see that the curve changed in that intermediate term. We think it's temporary, transitory, if I could use the word, but it's something to definitely be watching.
So I think this is a great time for us to have a pause, right? As we enter the world of discovery, right? And we talked about inflation a lot here. So if you're on your computer or are able to, go ahead and pull up the chat because we have a couple of quizzes coming at you. We got 2 questions here. And so the first one, we rewind the clocks back to 1974. And what we're asking here is what was the price of a Disney World ticket back in 1974?
So put it into the Q&A section so we can see it. So the first question is, Jake.
First question is the price of a Disney World ticket in 1974, and we got a correct answer from Aaron. Yep, it was A with $8 a ticket.
We'll come back to the second question a little later, but that's amazing. Oh, let's go ahead and do it now. Keep the flow going. But $8 to get into Disney, and that was the most expensive ticket. That included like your e-tickets and the punch card and stuff.
Yeah, your fast pass, right? As it
Yeah.
was a different term back then. Um, so the second one, staying on the Disney side of things, what was the cost of a room at the Contemporary Resort Hotel when it opened in 1971? This is a lake view, and the choices here are A, $25, B, $44, C, $60, or D, $100. As a hint, today that room goes for $800 a night.
We've had a couple of people guess 60, and that's wrong. We'll give you a
We
few
got
more.
one, Steve. Yep, Steve got it right, which is B, $44.
All right. So we've got some gift certificates to one of our favorite local restaurants. I think this one is for Finn's here in Venice. If everyone's here in Venice, so that'll work out great. So we'll get those out to you tomorrow. Thank you very much for playing. Jake, maybe you and I can go to Finn's.
There we go.
If you're ever at Finn's and they have the grilled swordfish that they have on that Jasper oven, it is the best ever. So we have the break though. Besides just the quizzes, you'll notice that we're moving to EPCOT. And so we're switching from Main Street USA and talking about what's going on in the economy. Now we want to talk about things that are changing our outlook on investing. And Jake, why don't you introduce our first?
Happy to. This deals with artificial intelligence, AI, right? This is something that is in the news every day. We've got a lot of companies here that are benefiting from this tailwind, especially on the semiconductor side. But as Scott mentioned, there's a lot of businesses that are implementing AI into their processes and day to day. And so the two charts that we're show here, first starting on the left-hand side, this is looking at capital expenditures from the major AI hyperscalers. These are companies like Alphabet, Amazon, Meta, and Microsoft. And what they're doing is they're spending an enormous amount and investing in these AI chips and infrastructure to improve their learning models and machine learning processes that they have. Right now, we're seeing an increase in expectations, right? If you look back at the basically since 2020, companies were spending a little bit on AI, as that was a buzzword and a theme that companies were looking to get into. But that has exponentially risen since then, and the pace of advancement is continued to or is expected to continue over the next couple of years. So Scott, what's your thought on that? And then perhaps, take us through what you're starting to see in other businesses, even those that are not technologically related, that are being
Right.
able to use AI.
Well, one is this is a land rush. It's real. The flip flop that we did this week as a country, saying we can't sell NVIDIA chips to China, to yes, we can. It's all about this idea that there is a land grab, and whoever puts their flag into that new land is going to have a permanent residence, and you don't want to miss out. And so it is enormous. We've got, because of Silicon Valley predominantly, as well as some people like Jensen Huang, who is an immigrant from Taiwan, with NVIDIA. It's just been incredible. So it's been, first of all, it's been an incredible investment for us at FourThought. We've been owners of Broadcom in really one of our biggest positions, and NVIDIA has been a big position for us, and that's been wonderful. But I know we all have our AI stories. I'm doing three things right now. One, as many of you know, I'm writing a book, and it's a book about multi-generational holistic planning, and the ability of for writing and thought generation. It goes up exponentially. Another example is any kind of research. So getting an idea of what the room cost when the Contemporary Hotel opened up in 1971, that would have taken us with a regular Google search maybe 10, 15 minutes to go through the sites and find it. It's instantaneous now. So we're just able to do a lot more. And I think I've shared this with you now, but we've got a system in our industry, and it came out right away, where we can have an electronic note keeper. So it's not really recording voices, but it's taking notes. And then we put in who the participants are. It kind of gives us, here's what the meeting was about. Here are the takeaways from the meeting. Then it connects to our, we call it a CRM, but it's the client relationship management part of our business. And it actually assigns tasks. I mean, it's mind boggling. And that's just happened in, 8 months. So what I think, is going to be happening is, as AI and the use of AI starts to matriculate into the different industries, the productivity of the American worker and the world worker is going to explode. There's also a bunch of other repercussions, especially the impact on children, the development of thinking and critical thinking, all sorts of challenges that we have. But strictly from an investment perspective, we're not taking the foot off the gas. This is a phenomenal opportunity. We live in a really unique time, and we're looking at ways of developing that out. And it's not just public companies. We'll talk about that in just a second.
That's a really great point. And transitioning from AI into alternative investments, I think this is another sort of asset class or theme that's really picked up steam more recently. And I'll explain this chart, but one thing that's kind of happened over the last decade or so is that the alternative investment world, we're talking about private real estate, private credit, private equity, hedge funds. These had been asset classes that really only large institutions could get their hands on and have access to. And that's endowments or insurance plans, pension plans, etc. However, more recently, through technological advancements, more and more of these alternative investments are being offered to private wealth clients. And there's different accreditation levels, and there's liquidity concerns that we have to know and prepare for. So it's not suitable for everybody, but for those that it is suitable for, it can really help sort of balance out risk and return profiles in a client portfolio. However, one thing that is incredibly important is that manager selection is a big issue. And what this chart shows is the mean or the average kind of return here for these different asset classes. And the bar charts that you see is the range from the bottom quartile manager to the top quartile manager. And what you see is that a lot of those private markets or alternative investments have very wide ranges. For example, within global large cap equities, the median return was right about 8%. And if you went up to the 75th percentile, you only went up to 8.9%. Like the range was only 8.9 to 7.2%. Not even 200 full basis points. Whereas if you look at private equity, for example, the top quartile managers average around 21% versus the bottom quartile, we're just at 1.5%. So that's about a 2,000 basis points change there. So Scott, very important thing to know as we're sort of looking at innovation and maybe investing differently in this new sort of market here. What are some things that jump out to you?
So, by the way, we got a question from one of our watchers about luxury goods. I see it. We're going to come back to that in a slide in a few minutes. So don't let me forget. So one of the radical changes that's taking place now is the huge increase in private investing. And by private investing, that's synonymous with alternatives. It's a group of investments that includes private real estate, gold, Bitcoin, private equity, venture capital, hedge funds. I mean, it's just a laundry list of things. But I want to focus on a couple that we think you need to be aware of. One is private equity. So it used to be that private equity was only for the ultra wealthy. Even if you had $10 million, it was hard for you to really play in that space. But, NASDAQ, which is, when it's an exchange, but it's also a company, they've invested in a technology that allows private equity to be offered through a mutual fund. And that is really interesting because to be a 1940 Act is what we call it. It's based on the Securities Act of 1940. You have to have daily valuations, you have to have liquidity, and there's certain limits. Well, they've done that. It may not be as pure of a private equity offering as, say, a regular private equity, but it's starting to democratize and open up things like private equity, private real estate, private credit to investors that aren't just the ultra high net worth. So you have that. Another thing that's happening are the companies themselves. So OpenAI, ChatGPT, it's one of the most valuable companies. It's not public. You can't buy it. SpaceX, not public. So there's these companies that are growing. They have no problem getting capital because the private markets are just flush with money. The statistics are really interesting. The number of publicly traded companies, I wrote this down. In 1997, there were 8,000 publicly traded companies. Now there's less than 5,500. Now the market capitalization of the markets is higher, so we have fewer companies and those companies are bigger. And so the rapid growth is happening in the private markets. So one of the reasons FourThought affiliated with Focus 2 years ago was to get access to quality private equity. We didn't like what was coming, was available to us and through Wells Fargo. It was just too big, and they didn't have access to, in our opinion, the best managers. So, Focus has got a whole division. There's a gentleman by the name of Lane McDonald. He works with SCS. He's a former gold medalist for the hockey team in '88, but after that, he ended up running Harvard's private equity arm. And now, he's with SCS and Focus. And so we have access and the returns. If you're looking at the risk rewards for select investors, it's just substantially more opportunistic than the public markets. So same thing with core real estate and a lot with private debt. Now, private debt, we're a lot more cautious on. So the big private debt offerings out there are primarily people loaning money to private equity companies to buy out other companies. We're not so excited about that, but real estate-backed private debt is very interesting. So one of the things that we're recommending for folks is as we go into this brave new world, here's an area where we can still find great values and good growth potential.
Yeah, a couple more slides here as we approach kind of the last 10 minutes, but these are all very important, charts here and items to factor in. The first one looks at the average tariff rate on US goods imports, right? And so we had kind of the peak, which came back in April, set the market down when those were worse than expected. We had an effective tariff rate at 30% back then. And if you look at where we're at now, through some negotiating and some of those have been reduced, we're at about 15%. So Scott, what's your take there? Obviously, we're still much higher than we were previously, and what's your kind of read on it?
Well, a tariff is a tax, and in reality, it's a sales tax. So consumers pay a higher price, particularly on imported products. But what will happen is domestic products will be repriced to the level of those imported products. So this is going to have an impact on inflation, because that's the cost of goods. but it hasn't had the kind of impact that people anticipated. So that's really interesting. And there's some absorption that's taking place. Also, we're raising, I can't remember the number, but it's trillions of dollars through this tax. But remember, those folks that pay the highest percentage of a sales tax are always the poorest. So it's quite a bit of a regression there, but it is going to have a positive impact on U.S. manufacturing. We have a client, for example, that makes rubber products and could not compete with the Chinese mat imports, but now with the high tariff, they can. So that's a positive thing. So tariffs, the classic economist in you says that when you have these artificial tariffs, it destroys competition and it creates kind of a gum in the machine across the board. The pro-tariff lobby will be telling us that that might be true, but it's not fair now, and this makes it more fair. I don't believe that when people understand this whole trade deficit thing, that it's not realistic, nor is it even desirable for us to have a positive trade flow with each. Let me give you an example. I've got a service that cuts our yard, and we pay him, let's say, $300 a month. His name is, let's just call him Fred. So I have a trade deficit with Fred. Fred doesn't invest with me, doesn't buy any of my product. I just am giving him, but it frees me up to do higher value things. And so, we look at the impact of tariffs. One of the big impacts that have changed, recently is the Chinese fighting back on rare earths. So we have these materials primarily used in magnetics. In China, they just don't have the environmental concerns that we have. They'll take a mountain and they'll push these chemicals through the mountains so the rare earths come out the bottom. There's no way we would allow a company to do that in our country. The environmental impact is just enormous. So you got a bunch of things in there that we need to pay attention to. But the bottom line is, so far, it hasn't had the big impact that economists were predicting. But it will have an impact, and it may be a little longer lag than what we expect. But at the same time, you've got AI and you've got deregulation happening, which we haven't talked about. So in this soup of government policies, you've got some flavors that are sweet and some flavors that are sour, but the whole soup, it hasn't changed the actual flavor of the overall soup.
Yeah, that's a great point. And now looking at kind of where we're at in global markets, right? So we hit the tariffs, we hit AI. What's surprising to me is that the dollar is down, about 11% year to date, Scott.
Yep.
And so that's had kind of a spring forward with international companies. And walk us through some of the stats, Scott. I know you have the returns of the international markets versus the US. This chart right here specifically, it looks at these cycles that we have when either the US outperforms international markets, and that would be like below that line, which we've seen basically since the 2010 type years. And then we've also seen periods where the international has outperformed the US. So Scott, what are the stats?
Yeah, so the gray area there is when the dollar is declining. You can see international stocks do well. And it makes sense. I mean, if you have a dollar and you ship it over to Europe and the dollar drops 10% and you bring it back, if it's in euros, you just made 10% on your money, and really nothing else happened besides currency fluctuation. So when you see the dollar declining, investments in overseas assets hold their value while the dollar declines, so you get extra return. And you can see it's been a long time since international stocks in particular have outperformed the US stocks, primarily because of what's happened in the technology space. But we believe that now is the time to go down, what do they call it in EPCOT? The World Showcase.
Yep.
There's just so much happening in the international market. So, for example, it's not fair And everybody since John F. Kennedy has asked NATO to pick up a bigger percentage of its budget, right? Europe, I mean, to pick up a bigger percentage of NATO's budget. U.S. has been 60%, and they all say yes, 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 but they never do anything. Well, now they're doing something about it. And you can see Germany, for example, taking on debt that they would have never otherwise done, and they're picking up more of the budget. So they say, hooray. Now, just because something is good for Germany doesn't mean it's bad for us. We got to get out of this us versus them. These are our friends, but the Germans in particular are massively investing in defense and aerospace. The same with the French, the Poles, and these other countries. So what we're starting to see is a really strong stimulus hitting those economies. I mean, they are taking on debt and investing in manufacturing, and they're doing it domestically. And also, there's some very big technology companies. ASML is one. There's a company called Trump. It's a private company. It's not anything to do with Donald Trump. It's a long-time machining company that is really the only ones that can make the lithography tools that go into an ASML manufacture. So it's so much wrapped up into this. So there's a lot of catalysts that says, hey, now's a good time to be investing internationally, not the least of which is the dollar dropping.
And staying on that international equity, right, and global markets, these couple charts are very fascinating too, because the US markets have done so well, especially coming out of COVID. It's been really tough to beat, especially like large cap growth, right? US growth stocks have just done extremely well. But looking on the right hand side, there are actually some pockets internationally that have outperformed US growth, which is the gray line there. So looking at the very top, Scott, you just talked about it, Europe, aerospace, and defense. I mean, since October of 2022, that has just about doubled U.S. growth. I mean, that's been fascinating to see. Also, we have international developed market banks, Taiwan technology. That's mostly going to be Taiwan semiconductor, right? Those three themes or like categories of investing have actually beat U.S. growth stocks. And there's more too, like India consumer discretionary and Europe luxury goods that haven't done quite as well, but we kind of see some room for that to springboard potentially. What's your thought on that, Scott?
Well said, Jake. Point being is that since 22, these other areas have actually done better. And I noticed when we had the Japan trade deal, it helped us, but it really helped Japan. Toyota was up 15%, for example. And one of our clients asked the question, hey, for our folks that have like a $10 million net worth or in excess of that, are we seeing them changing their spending patterns, specifically around luxury goods? And the short answer is no, we're not. So we're still seeing, they're still spending. It's not having any impact. But where we are seeing an impact is in the Chinese purchases of luxury goods. That's been dramatic, and it specifically has hit the European luxury goods and all luxury goods. So that's where you see that tail off there. It's not so much anything to do with the European economy as much as the Chinese demand for U.S. and European luxury goods.
Yeah, especially like LVMH and Kering, like a lot of those companies really have struggled. And looking at the demographics, the U.S. market, participants or consumers have basically been steady. But yeah, that region from APAC has really brought them down.
Thanks for your question.
And so
Any other questions, please pop them in there.
Yeah, thanks, Scott. Also, looking at international stocks, generally speaking, from valuations, yield, etc., why the international market still could be interesting even after its outperformance recently. The first thing that sticks out to me is that they trade at a very discounted valuation versus the domestic markets. We mentioned that currently the S&P 500 trades at 22 times earnings. Looking at some of these other markets on the left-hand side, you got Japan at under 15 times earnings, European stocks under 15 times, EM, emerging markets, China, below 13 times earnings. So you're paying less per these for these stocks per dollar of earnings or profits that they're generating. That is attractive, and also there's the dividend yields to look at too. Scott, what's your stats there that we have for dividend yield versus the U.S. markets, which we noted were well below 2% in dividend yields?
So point is, the European stocks have got some fundamental things happening for them. International stocks, one, the dollar's dropping. Two, there's stimulus that's happening. Three, they're undervalued relative to the US. And finally, they have higher yields. Now, speaking of yields, let's look at the treasury market, Jake.
Right. So when we think about fixed income or bonds, right, there's a very high correlation between the yield that you get when you purchase the bond and the subsequent return that you get on that bond. And it's pretty intuitive. If you buy a bond that's yielding 5%, and let's say it's priced at par, you're going to collect your 5% coupon. Let's say it's an annual coupon bond. And then at the end of the term, you get your last coupon and you get your principal back. So what can change your annualized return of that bond? Well, it could be if interest rates change, right? There's something that's called duration and convexity, and that can change your kind of overall return stream. But for the most part, especially for buy and hold investors, a very high correlation on fixed income yields and your actual returns. And so looking at where we're at now, the current yield of about 4.5% means you're probably going to end up with a 5-year return of about 4.5%. So I think, Scott, one thing that jumps out to me is these yields are higher than they have been, especially since COVID when rates were dropped. And so there is an alternative to the equity market where you can earn a rate of return that is higher than inflation, and you don't have to take on a lot of risk. But also there are factors where we don't think that bonds are extremely attractive. We're kind of at like a neutral weight for bonds. There's a lot of issuance of treasuries that are probably going to come down the road, and with inflation potentially looking to heat up over the next year or so, those are risks that we think could really negatively impact bonds. But Scott, what are your thoughts on kind of fixed income versus equities and alternatives? Where do they kind of fit in?
Yeah, I mean, a 4.5% return when you're getting a 3% inflation rate, it's not horrible, especially when we're coming over a 5-year period where inflation was actually more than the bond yields and you were losing money. The bond market is going through some wacky things. One, we're just borrowing a ton of money. The other thing is we're introducing these stable coins, and those stable coins, it's a type of cryptocurrency that maintains a value. Most of those that I've seen, they have to have bonds backing them. And so it's creating this demand for US bonds. So there's a lot of interesting things happening. Bottom line, Jake is talking our story here when he says duration and convexity. I think he's flirting with us. The reality is there's no real reason to take risk in the issuer. You're only picking up a little return, and there's no reason to go really far out. So keep it short. It's a great time to be laddering bonds. And one area that continues to be attractive are tax-free bonds. So keep them short, keep them laddered, go tax-free.
Scott, we have one final question that came in, and I'll answer it
Oh,
quickly.
I didn't see that.
Yeah, so we talked a lot about foreign stocks, international investing, and why those markets are still looking pretty attractive. And that is an area where we have been investing in for a good amount of time. In fact, we've actually maintained an overweight in international stocks within our model portfolios. And a lot of our kind of top positions in our strategies are actually international names like Taiwan Semiconductor and ASML.
And
So
Broadcom.
yeah, Broadcom definitely. So definitely that is a market that we're leaning into. It's not really as much of a top down call as it is that we're finding really incredible businesses that are really diversified from a geographical standpoint, and their profits and earnings expectations are very impressive. And we think the market had mispriced them. And they happen to be in the international market. So, we don't have a crystal ball to say where the dollar is going tomorrow, but we important to overall businesses, especially within technology and semiconductors. And we've been able to find some great companies there. So hopefully that answers that question. And Scott, I'll hand it back to you to kind of take us home.
Thanks, Jake. We have a rules-based process for stock selection, and Jake and his team go through, and it's, what are the consistency of earnings growth, the valuations, how is the mode of the company? And if the company like Broadcom, all of its business, its headquarters, et cetera, are U.S. based, but it's for some reason a Taiwanese company. I don't understand it, but there you have it. So you got a lot of just kind of quirky things that are happening there. Yeah. So to summarize, what I hope you get out of today is that when we looked at the cauldron of things that we were concerned about at the beginning of the year, regardless of your politics, there's been a lot of the concern has been lifted. We're not hearing about recession. We're not seeing the treasury market going crazy anymore. There was a time where the treasury market, within the last year moved 20% in a day. That's borderline dysfunction. It's just, we're not seeing that. And we're seeing opportunities, especially in some of the areas that we spoke of today. So what we're recommending is take a look at your portfolio. If you know you're going to need money, make sure it's not in the stock market, not because we're predicting anything, but just because the market's high and there's risk out there. Point number one. Point number two, we are going to be continuing to look at our international allocations and look to dial it up. That's where we're seeing the real opportunities. Point number three, don't forget alternative investments. It's a new and wonderful world. If you want to participate in the world of AI and some of this most innovative investing, quantum computing, you're not finding those companies in the public markets. And some of the companies that you find in the public markets are scams and not great. So you have to go into this, especially if you're younger, into these alternative investments. And we're happy to have those options for you. Your bonds, keep them short, keep them high quality. And as always, we are just blessed to have clients and trust us. Know that we are thinking every day about how we can help you make better decisions and experience life with less stress. And finally, as I love to say, if I could get my tooth to glitter, remember, great planning requires forethought. God bless everyone. Thank you again for your business, and we'll be talking with you soon.